Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Now, before I get started, I just want to say it has been a very tough week for humanity, and that our hearts go out to all the people impacted by the events in the Middle East. It's hard to sit here and talk about investing in financial markets when such tragedy is taking place, but we must. So with that being said, today's episode is sponsored by the award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. It's an exciting time for Zephyr's Adjusted for Risk podcast. We've made it to season 2. Yep, that's right. Season 2 is upon us. We have not been canceled yet. With the new season ahead of us, we've decided that we need to take the production and professionalism to the next level. We've done so by incorporating an awesome new professional intro that you saw at the beginning of this episode to the podcast, which shows just how excited we are for the future. And despite the changes and the added professionalism and content and production to the podcast, we are working on an amazing star-studded lineup of guests that's going to bring fantastic, insightful content to the same fun and engaging casual environment that will help you all make more informed investment decisions on behalf of your clients. I want to thank you all the listeners out there for listening and supporting this podcast along the way, along with wealthmanagement.com team, which distributes the podcast across their channels. So thank you all very much. Continue to smash that subscribe button and like button as we continue through season 2, which is sure to be bigger and better than the first one with some fantastic guests. So with all that being said, I will be starting off season 2 with an update on financial markets, risks, and considerations when creating an investment portfolio for your clients. It's a very complex market environment where the only certainty is uncertainty. Equities have rebounded the past 3 weeks as investors have been betting the Fed will pause its rate hikes, while the yield curve has shown signs of steepening. Economic data has been solid, and investors are forecasting a better than expected earnings season, all culminating in strong equity performance over the past 3 weeks. So let's begin with the Fed. It all starts really and ends with the Fed right now. As I mentioned, markets are forecasting the Fed will pause its rate hikes and continue to be data dependent and patient as the impacts of the aggressive hiking cycle trickles through the economy. Additionally, treasury yields, particularly longer dated treasuries, which I'm going to talk about here shortly, have climbed. These higher yields have resulted in tighter financial conditions. And as a result of these tighter financial conditions that the market is doing, that's helped make the Fed's job a lot easier. It's going to allow the Fed to pause, which will please equity investors. So the Fed is applauding these tighter financial conditions that markets have been causing. And that's going to help do the Fed's job. I mentioned yields. The yield curve will continue to drive equity performance. Like I said earlier, the yield curve has steepened recently, and there's no coincidence that equity markets and equities have increased and performed well during that same time period. Despite all the uncertainties investors are faced with today, the yield curve is driving the equity bus. Like I said, it has steepened lately after a lengthy period of being deeply inverted and that has provided a boost to equities. So continuing with yields and fixed income, which really have been the biggest story this year, it's been a tale of two stories. The short end of the yield curve has been very accurate in forecasting Fed rate decisions. And that's no surprise, as really the short end of the yield curve or shorter maturity yields are driven by the Fed and is now signaling the Fed is going to pause and keep rates at its current target range of 5.25% to 5.5%. So I can see shorter term yields trading in a range in the near term, meaning that short-term bonds have bottomed and are very close to bottoming. As they continue to forecast, the Fed is going to pause interest rates, keep it in that range, and resulting in a bottoming of shorter-term bonds, treasury bonds. However, long-term yields, which are driven by more factors than just monetary policies, have been much more puzzling and have lagged behind Fed comments, actions, and rhetoric. Long-term yields have been well below shorter dated yields, which, as we all know, is a signal that recession lies ahead and has been a predictor of every recession before time. But those longer dated yields have normalized in recent months, with the yields climbing higher. They finally got the message. Those longer maturity bonds have finally come around on the Fed's higher for longer rhetoric. It's about time, as they've been lagging and really not following that messaging from the Fed. Additionally, solid economic data in recent months have helped push longer dated yields higher. And lastly, I think inflation will continue to be sticky around that 3 handle and will experience a very slow decline from here. And that will place additional upward pressure on longer term yields. So in addition to sticky inflation, we also have stronger economic data, and the Fed's rhetoric of higher for longer. I think finally longer maturity yields are finally getting the message, and they're climbing upward. And I can't talk about all these yields, especially the longer dated yields, without mentioning supply. Treasury supply is going to spike, and with U.S. debt to GDP at 122%, that is sure to impact yields and has the potential to send yields higher. So with all that in mind, I think look for the yield curve to steepen as shorter maturity yields trade in a narrow range and longer term yields continue to climb. As for risks, like I said earlier, uncertainty is the only certainty. Since the beginning of the pandemic, have had this growing wall of worry. This wall hasn't eroded. However, the worries have changed. Now equity investors have to contend with yield volatility. Investors must contend with monetary policy uncertainty. There is uncertainty regarding the upcoming presidential election, geopolitics, labor strikes, and like I said, inflation isn't going down to 2% anytime soon. But with all that being said, focus on yields in the yield curve. Earnings, third quarter earnings season is upon us. While most are forecasting earnings to beat estimates, I think it really is more important to focus on corporate narratives this earnings season. I feel that earnings will beat expectations like most quarters, but rather than focusing so much on the number of beats or the quality of beats, focus on the narratives. What's impacting their earnings? And are these impacts temporary, systematic, or company specific? It's clear interest rates are going to be higher for longer. How are companies going to handle a new regime of higher rates versus being able to take advantage of very easy and cheap money like corporations have in recent years? Also, banks usually kick off the earnings season. So banks look at interest income and how the higher for longer rates and the extended period with the inverted yield curve, how have those two impacted earnings? So how does it all roll up into investment decision making? As we know, the market has a high concentration of mega tech stocks. These magnificent seven of mega tech stocks have driven market performance this year. Traditionally, higher yields and higher interest rates act as a headwind for tech stocks. Well, that obviously hasn't been the case this year. I recently did a Zephyr drawdown analysis on indexes of different sizes. While the Russell Top 50 index has a high concentration of tech stocks and obviously mega tech stocks, its recent drawdown of roughly 5% is a lot less than that of the Russell 2000 or small caps. So that is telling me it's all about quality right now and not so much about sector. If it was about sector, these tech names and the Russell 50, which is made up of a lot of tech names, would be struggling in not being able to withstand this market volatility and this market sell-off as well as they have. So that's why it's about quality. This has helped them withstand the steep spike in interest rates. These large corporations, whether they're tech companies or healthcare, but these large corporations are very strong balance sheets and they're flush with cash. So like I said, those are elements that have been able to have helped these companies withstand the tighter monetary environment. While lower quality companies like small caps have struggled as they carry higher debt loads and are much more sensitive to high interest rates, and as a result have experienced a much steeper drawdown. So continue to focus on quality and strong balance sheets as interest rates remain high and financial conditions continue to tighten. As those strong balance sheets and companies that are flush with cash are able to withstand tighter financial conditions, volatility, and be able to reduce drawdown risk. Additionally, portfolio diversification is going to be very important in this very complex environment. It's important to look outside just stocks and bonds. Look at adding or even increasing exposures to alternatives like private credit. These assets can help reduce correlations, which help portfolios get through the uncertainties and the volatility. Lastly, a great way to add alternatives to a portfolio is through separately managed accounts. Separately managed accounts provide professional investment management while also allowing flexibility to add investments like alternatives to these managed products. So with that, thank you everyone for listening to this episode of Zephyr's Adjusted for Risk podcast. Like always, you can watch all of our episodes on the Adjusted for Risk YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much and have a great rest of your week.